Hi, gang. Today we are going to talk about Smart Money Concepts, better known as SMC, and my Kairos work. The thing of it is there are plenty of videos of SMC. There's hundreds of them. You could see them. You don't need to learn that from me. And in fact, I want you to watch some of the better ones. There's some really good ones, and there's some ones that are just okay. And the ones that are just okay do provide an element of confusion, and I believe that they provide more questions than answers. But what I found is that, according to my price and time work, is that Kairos is SMC is a wonderful complement to Kairos. Likewise, Kairos is a wonderful complement to SMC. So if you're coming here from the SMC community for the first time, I don't believe it's an accident. I believe it's a divine appointment. And so today, what we're going to discuss are some concepts. I mean, you could get into more advanced in the SMC videos, but we're going to combine price and time squaring with factors like mitigation, fair value gaps, wick fills, and liquidity sweeps. Okay, so let's get started. There is your standard disclaimer. The contents of this work is not guaranteed to produce profits. This information is for educational purposes only, and viewing or purchase of any of this content constitutes you agree with this notice and exempts the authors, agent, distributors from any liability or litigation. You know I have to tell you that. Okay, so where did all this start? It started, I'd say, in the middle of last year. There was a downgrade by Fitch for U.S. debt. And see, for those of you who know my work, know that we have some incredible calculations. And those of you who don't, you're just going to have to just trust it for now or go see some of my other videos. But basically, what ended up happening is that at the close for the Dow futures, I think this was like last August in 2023, there was an incredible setup. It was 139 points up and it closed at 39 degrees. So the setup and the symmetry is perfect. And this bar, the leaning bar, was already there. And you know that's very rare that a session will beginning or end like that. And so like I'm all over this thing. This is going to be great. Okay. After market opens, what happens? Before you could even get a blink of an eye, I guess the micro traders, the super fast traders, whatever you call them, this thing dropped 234 points in 1 minute. There's no way you can catch it. And so I found that all very curious. And I'm not really going to get into it here, but let's just say this sequence opened my eyes to start taking a look to see. Everybody knows that there's games that are played during the day in the market. I wanted to get to the bottom of it. And you know what? This video and the manual that I've written and everything that I've done in my work since is a great testament to it. Okay, so for me, and I'm not, and I created this probability box for my people more so as a discipline. I mean, SMC, when you're talking SMC, you're talking about the really smart money. You're talking about the market makers, all those people. Okay, I don't even know. I'm not an insider. Some of you are insiders, so you'll know exactly what I'm talking about. But let me just say that I had started working on this stuff, and I saw a interview with a guy named Richie Nasso, who I think he was a floor trader on the NYSE. I don't know the guy had a brokerage firm in New York and Europe. From my understanding, billions of shares passed through his hands, and he was asked in an interview, "Do market makers like to run the stops?" And you know what he said? Every chance they get. So I'm just repeating to you what he said. So the purpose of us doing SMC is to defend ourselves, to make sure our stops don't get run, and to make sure that we could actually be on the right side of the market. So it's not a mystery to say that if we divide a box into four uh, levels. You got 25, 50, 75, and 100%. The lower 25% is going to be considered the discount zone. This is where smart money would prefer to buy. The top is going to be the premium zone, where they prefer to sell. The middle, that's the what I call the neutral zone. Those could go either way. And so the idea is to discipline yourself to go short in the premium zone, go long in the discount zone, but due to what we do here, which is price and time relationships, there is an exception to every rule, and we want to go against there are times where we need to go against this box. Now, the market makers are using a box like this, but they don't need it. I put the box here, and it won't be on all the charts to get my posse a little disciplined and get used to the fact that they shouldn't be obviously be going short when they should be going long, and vice versa. So to give you an idea how this works, combining the two, this is stock REGN. This is a discount zone buy. Okay. Now, why is this such a good setup? This is a daily chart. The low here is 668. And on the Gann calendar, and I've done another video on the Gann calendar, which you should watch. It's 168 degrees across. And that's your buy point, and that's where it takes off. So what we've done, for those of you who are SMC people, if you're looking to the right buy point, what we do here is wait for price and time to square out, and then when it jumps off the page at you, you had a pretty good opportunity. Now, one thing I learned from the SMC crowd is something called mitigation. And these are places where they're former buy areas where there's more buy orders that are left behind. They'll revisit that and they'll load up, and the same thing. Now, this is a very famous pattern. This is the NASDAQ top for 2000. And this is great pattern recognition. You'll see this sort of thing on a 1-minute chart. You'll see it on any chart when it lines up like this. These are usually a good short, but the reason is that there's probably a bunch of sell orders here and it got left, so they revisited, and that's where it dropped. See what I mean about a reliable pattern? Because this is the NASDAQ 2000 top with mitigation. And how does this work? What's the best signal here? The difference between the high and this secondary high is 127 points. The time difference is 28 days. The rest, they say, is history. Now, the thing that I found out about liquidity sweeps, and by no means am I the final word on this, is that they'll take it, they'll take something really close to resistance On a drift up, they'll drop it. So I guess the smart money gets to buy at the discount, and then they'll take it up. Now, in this case, we have a fair value gap at this sell block, and from other videos, you'll find out that fair value gaps make really good sell blocks, but for our work, we like to confirm it with a good price and time square out, okay? That's what we're doing. So we have a fair value gap here, and the fair value gap is the imbalance on a bigger bar, and it's the best way to explain it is the difference between the tails, and you have a blank area. The difference is the gap, and what they do is they look to fill it. And these fair value gaps, they act as a magnet to the price action. Now, let me just say that I am going to be skipping around. Take the concept, I'll skip around and I'll come back to it. That's going to be the course of this teaching. But why is this important? Because this high is 178 points up, and while this low to high is 61 degrees, from here to here is actually 78 degrees after 178 points, and that's where this thing stalled and where they had their little sweep. See what I mean? That's what happened. Because you got 178 points, you've got 78 degrees, you got to move down to the buy zone. And that's that. But this is a different chart. Okay? Take a close look here, and you could see what the fair value gap is. This is your imbalance, this big bar. It's a big, fast bar. And what they look to do is balance it out. And they take the high of the wick, the low of this other wick, they take the difference, and this comes down to become the buy point. There's a lot of videos that teach that. Here's another fair value gap. See the gap in between the tails on the candles? And look at how that rallies right up to the line. Right up to the line. Is that amazing? And so it acts as resistance, as you can see. Now, at this moment, I'm not getting into the combination of the price and time with the SMC tactics, because what I want to do is just introduce some of the price and time people so they have some type of an awareness of what it is we're even talking about when it comes to a fair value gap. And this is the structure of it. This is the target of it. And what we're really looking for here would be some type of a relationship. So we would feel better about going short here. And there's your follow through. So that's basically how it works. Now, what is a liquidity sweep? I'm sure there's plenty of other definitions for it. There's technical definitions for it. But if I was going to explain this to a layman for the first time in an introductory course on SMC, I'd say it's a slow drift up coming to resistance where the smart money decides to drop it down to support where they can get a better price and run the stops. Is that fair? For instance, here's your slow drift up. You have a polarity flip here, but now let's start to introduce some of my price and time. From down here to here, we're looking at 243 points. So now we have this drift higher. And by the way, this is the open one morning on the Dow futures. So what they basically did is they go, it's all right, it's 243 points up. The resistance is at 42 minutes. That's your replication point. They sell it off. They take it all the way down to this important wick and this buy zone, and then they take it right back up. See how that goes? Now, down here, you're looking, I've already shown you on the last chart, you have 243 points. You have 42 minutes, and the low at the important wick is 986 and 986, and the low is 29. That's a difference of 43 points. So if you're wondering where the buy point is on the buy block, there's your buy block, right? It's all so confusing as to what you should do, especially when this drops below all of this. Now, all these people, if these people were long, their stops got run and they're out. Am I wrong? So now you have the price in Times Square out combined with the liquidity sweep, and then you've got the move of the morning. And they were really waiting to get this set up. They see the thing for me is why don't they just take it up over here? See, this initial, like they could keep going, right? But they don't. And there's a reason for it. And they take it down to the buy block. I'm sure there's other longs down here that would like to get in at a good price, and they do. Now look how nice. Now where's a potential buy point? The last red bar before the bottom is 62, right? Now we have everything lining up with the 43 points where if you're a trader, you're going to fight for the best entering position. That's the way it is. And different people have different methods. Here you have a high price of 62. I'm looking at to see a close above 62. And here what probably happened on this green bar is that it went above 62 and it didn't close above 62. So they play this little game as to if it's really going to go, but then the next one goes. And so let's talk about wick fills. Wick fills are fascinating because like you, I got a lot of my training from Steve Nissen, and I've read all his books. I took his advanced courses. I've told this to my clients, I don't know, many times. But what I will say for Mr. Nissen and the rest of the Japanese candlestick establishment is they're very, very good. Okay. I mean, I have because of them, all of my charts are candlesticks. But here's the thing. They pay more attention to the candle body, while the SMC crowd, what I've found is that they pay a lot more attention to the wick on the candle than most intermediate traders realize. I'm sure that there's going to be a lot of advanced traders that know this, and maybe if you don't, you will now. So what I'm trying to show you here is a proper, healthy candle example is that if you're going to get the follow through, it's going to usually come on the next bar, and it's going to be tight, and the formation is going to be really good. So just look at this as a prototype of what you're looking for in a clean market. The follow through on a wick fill is very important, and I'm skipping around so you can get it. Okay, this is really good structure because there's no red here. You see one green bar, two green bars, three green, no red. That's really good structure, and that's showing strength and it's showing momentum. But the reason that this chart is here is that we have a retest of support on a lower wick, and see, the intermediate level trader is going to automatically think that the wick is that should hold. But a lot of times that wick is going to get filled. And the point that's here is if it doesn't get filled and if it takes off and leaves the tail, that's the follow through for you to know that the prior wick, this low, is tending to being an exhaustion wick to the downside. Let me repeat that. What we're trying to understand, not so much the real candle body, what we're trying to understand is, will that tail, that big tail, will it be filled or will it be followed through on? And that answer comes very quickly. Okay? Here's another wick. Now this is poor follow through. Does the next bar off of here, next candle, does it just go down like this one did? I mean, this one's immediate, right? This one is not, because this one, it partially fills, it drops, so it doesn't have the follow through that you would like, and then it totally fills it. So you have to, my best advice to you is pay more attention to the wicks going forward and see how they behave and see how they become a harbinger for the trend or not. Like this one here. Right here, you got this upper body candle, but you got the good follow through and it keeps going. But in this case, it doesn't. And so you don't have to be afraid of wick fills anymore or big candles, because now you'll understand that if you see a big wick like this, it could be directional, especially when you don't get the immediate follow through to the downside. Consider that you want to see wicks get filled. I know that's an attitude adjustment for a lot of beginning traders, a lot of intermediate level traders, and to those of you who are beginners, realize that a lot of us more senior guys didn't figure this out for years. So just by sitting here and watching a video like this, you are like cutting down on your learning curve exponentially. Here's a wick fill. No downside follow through, right? And what it does, eventually fills it. And this is a great example of what I'm trying to show you. Upper tail, no drop, new high. Upper tail, immediate follow through, trend continues. Upper tail, immediate follow through, trend continues. And here, you've got a lower wick, no follow through, trend goes higher. Big wick like this, no downside action, it's going to get filled. Not every time, but a lot of times. And like I showed you, very great structure for trends. This, you're looking at great structure. You can get yourself involved in something like this. If you're saying to yourself, well, gee, am I going to be convicted to hang in there and let a winner run? If you've got, if your trend is starting like this, you've got a really good shot at it. And patterns, magnets to mitigation points. Here, this zone drops, comes right back to it, stalls. So the thing is, to look at it one way, if you're looking at a trend and you look at where the mitigation points are, and then you should think, okay, I shouldn't consider a serious trend change until it gets to the mitigation point. I should consider any like move off a high like here as a buying opportunity as opposed to selling, because it's going to challenge that mitigation point. Not every time, but a lot of times. So if you can get that structure right in your head, then you could start to take some of my work, which is the price and time square outs that you see in these charts, and you will just have a better feeling, a better conviction to know that you're going to be on the right side more often than not. Okay. Now, this is a liquidity sweep. These people thought they're going long, right? I got my premium box here, premium zone, discount zone. We have a high. We have 61 degrees in a different time frame. No, it's 61 degrees here, right? It's 61 degrees. Here's the calculation. It's 61 degrees from the high to here, and the price is 262. So it all lines up perfectly. And unfortunately, the smart money gets to buy it at the best possible price. But this is another perfect example of how you take SMC, Smart Money Concepts, and line it up with price and time squaring to find the point that actually jumps off the page at you. And this is just another example of this is a textbook example of how a wick should behave if it's good, follow through right to there, and it actually becomes a fulcrum for all the action. And remember, I showed you the NASDAQ 2000 and the NASDAQ 2007 highs, and how the secondary becomes a mitigation. But it's the same thing. And what is this? This is a 4-minute chart. So you're seeing the same type of pattern recognition stuff, and now we're explaining it. Now we're combining it with all the calculations so we could be even more precise. And how do you know that it's a sweep? Look, these patterns are so complicated to an intermediate level trader, because think about it for a minute. You got major resistance up here, but you've got resistance here. It takes out resistance here. It goes all the way back down to the low. And then it just turns around and goes straight back up to a new high. Now, for many years, I'd look at that and I'd go, why did it do that? Do I have the conviction to go long? Probably not. But this is perfectly in the buy zone. And there it goes, right? So now when you look at this stuff and you see this sort of thing on your own patterns, you'll have a better idea of what's going on. And you certainly want to be careful to never become somebody else's liquidity. And once again, this is a really good example of a fair value gap. Okay, big imbalance bar. You got your wicks here. You got your wicks here, and look what happens. All that they're just what they're doing is they're trying to fill it. Okay, if you could just understand that, and you're gonna beat half the game. Okay. So now where's the drop point? Now here's my price and time stuff. You end up right here at the high end of the fair value gap, which is 350, and from 350 to the drop point, it's 49 bars. And that's the trade. Now look at, they give you another one over here. You've got a high of 23, you've got 23 bars, and you get another leg down. Pretty cool, isn't it? Now let me just say right here, because I'm new at this, and I'm still learning how to edit it. You like charts like this, please hit the subscribe button. Please hit the like button. Smash that like button. You see a chart that you like, hit the like button. Okay, now when to go against the probability box. This is Texas Instruments, a daily time frame, and we're using the Gann calendar. Okay, and this is really right close to the discount zone. The people should be looking to buy it. If you're watching a lot of the SMC videos and they don't have, and there isn't an answer for why the trade didn't work in the discount zone, this is why. You have a high and the Gann calendar at 123-degree day. That's the 123-degree day of the year. The secondary high is 152. 152 DG day. Okay, now if I showed you the intraday chart, from the low to here was 152 hours. So the pattern terminated at 152 hours on the 152 DG day of the year. And that's the kind of thing that will help you go against the probability. And you really have to understand my work to be able to do something like this, okay? And yeah, here it is. What do you know? I'm showing it to you. It's actually what it is. It's 152 hours off the high. It's not 152 hours up. It's 152 hours off the high. And but the amazing thing is 152 DG day of the year. So, and then again, the difference is 29 degrees. It's actually a 31% retracement, so that's in the 2 margin of error. And what I'll just briefly tell you guys about the Gann calendar is that each day of the year represents a certain vibration based on the orbit of the Earth. And what we're looking at is just one of the manifestations of it, of how it embeds itself in the pattern, how it's 100. Why would 152 be important if it's the 213 DG day of the year? That probably doesn't work. Maybe on that day, maybe 213 hours will be important, or 213 15-minute bars, or 213 1-minute bars. Okay, you see what I'm saying? So this is the follow through for this, and that's when you go against the probability box. Okay, it looks like on this chart we're back to the wicks again. This is a pretty big wick. Now this is the follow through that we're looking for. It's very clean, and when it's very clean off a major move, of a big time wick like that, that usually is going to start the move. It would help if it has a calculation too. So this is another one of those. This is actually a gap down, but it's also a fair value gap. It's a fair value gap on the weekly. This is the daily chart, okay? And here it's the perfect mitigation point. What can you say about this? And this is, look, it's a short-term trade. It goes 10 points. Let's see. It drops 10. This drops 10 points. In how 1, 2, 3. This is a good swing trade. It's a good swing trade, and if you don't just walk away from it and forget about it, if you're monitoring it, there's nothing wrong with that. Okay, here's a practical value of a fair value gap. Okay, we have it's I know it's probably harder to see, but the fair value gap is here. Okay, so what ends up happening is that the origin of the pattern, and this is the HGX. This is the housing index. And this is when this is the rally and the pullback from 2023. So it starts on the 354 DG vibrational day of the year. Okay, we go forward 155 trading days to where the pattern, my price and time squaring, lines up with the SMC with their fair value gap. And look at that incredible move. And I just want to show you a classic exhaustion wick. It's a retest of a prior wick, and it has that clean follow through. So that's basically our introduction. If you're interested, we have a lot of manuals that are available. I have one that teaches on replication. We have another one called How Patterns Terminate, which you Elliottician people are going to like because that shows how the last leg of a pattern, how the price and time, what it does is it influences the entire pattern. The secret pattern package shows how the first leg of the pattern works, how it influences, and I'll just share with you that if we go back to the 1929 to 1932 crash, the actual crash itself was 49% in 49 days, and it took me 10 years to figure out that the bottom in 1932 was 149 weeks. So the first leg was the harbinger for the entire thing. And of course, missing link volume 1 is the Gann calendar. So normally all this at 250. You can have them all 5 for 217 plus a fast start guide. And it might be hard to see my email here. It's lucaswaveman@gmail.com in PayPal, or request an invoice from this video. And if you're interested in further, we have a special here at $587 for mentoring. Includes a call every other week for 12 months. Unlimited email support, all the manuals, complete NFL size playbook, intraday swing position, investing, all of this. Email lucaswaveman@gmail.com. All right, gang. I think that's going to be it for today. Thanks for coming, and I'll see you in the next video.